Hello and welcome to the Tax Roundup for October, and it's been a huge and busy month. Inside this month, we're going to take a look at the tax treatment of distributions to foreign beneficiaries from Australian discretionary trusts. Now, the CGT impact may surprise many people and will have an impact on clients. We're also going to take a look at Treasury's attempts to align the definitions in FBT and GST legislation for ride-sharing services, to have them both treated as taxi services. And then Garth is going to take a look at the legislation that went through Parliament the other day that has an impact on the calculation of total superannuation balance, and it takes into account LRBAs. But first up, the big news, of course, is the reintroduction of the super guarantee Amnesty into Parliament. And Michael Carruthers is going to take you through the parameters and the implications of that amnesty. Across to you, Michael.
One of the big news items this month is the reintroduction of a bill containing an SG amnesty. This is something we saw a little while back, turned out to be a little bit messy and never went through. Looks like the government's going to have another go at it, and we'll wait and see whether it does end up going through. But presumably the government has done some sort of work behind the scenes to reassess its chances of this legislation actually making it through Parliament. Now, if it does, basically what we're seeing is very similar to the proposed amnesty from last year, but with another feature to it, and it's a bit of a stick feature. So the way that amnesty is proposed to work is that where employers basically come forward and notify the ATO of outstanding SG liabilities from prior periods, there are some advantages available to them compared with what would have happened had they actually fully complied with the SGC penalty regime. So for those employers, the benefit of taking advantage of the amnesty is that those outstanding super amounts, the actual contribution amount, will be deductible, which is a pretty big advantage because normally where you pay SGC amounts after the relevant quarterly deadline, those amounts cannot be deducted. So that's the first benefit. A deduction can be available for those super contribution amounts. The second advantage is that the admin component of the SGC amount is basically disregarded. So an employer would still need to pay the super contribution amount. They would need to pay the nominal interest amount, and that's basically to compensate the employee for the fact that that money hasn't been sitting in their super fund for the relevant period of time. But the employer basically would not have to pay the additional quarterly admin component that would normally form part of the SGC amount. The other thing is that the penalty, the additional penalty that can sometimes be imposed by the ATO on SGC amounts, basically there'd be relief in that situation as well. So the employer would still have an amount to pay, there'd be an interest component as well, but certain amounts would be deductible and certain penalty components wouldn't be applied. Now, there are some tricks to this. First of all, the employer would need to notify the ATO in the approved form within the amnesty period. And the amnesty period basically runs from, it looks like when the amnesty, the original version of the amnesty was announced in May 2018, the deadline would then be 6 months after the bill, if it's passed, receives royal assent. So given what happened last time around, I assume some businesses will maybe start thinking about this, but might not be taking really active steps to do much about it until they see this bill actually pass through Parliament. Well, if that's the case, what we're seeing is that there'll be a 6-month deadline to then actually comply with this amnesty. Not only would you need to notify the ATO within that 6-month period, you would actually, as an employer, have to have paid the super guarantee amounts as well to take full advantage of the amnesty. So notifying is on its own isn't enough. You've got to notify and pay or enter into a payment arrangement with the ATO and make sure that you're keeping up with whatever payment arrangement you've managed to negotiate with the ATO. So that's the benefit of taking advantage of the amnesty. Well, the other side of it is, and the other part to the bill, is that if you don't take advantage of the amnesty, and it turns out that as an employer you have outstanding SG obligations for one of the periods covered by the amnesty, then things are probably going to be worse for you if that ends up being picked up by the ATO. So what the rules will do is immediately after the amnesty ends, the penalty provisions will be amended so that the minimum penalty that the ATO will apply on top of any SGC amounts is 100% of the SGC amount. So in some cases where you have an SGC liability, the ATO can impose another penalty on top of all of that. And it can be up to 200% of the SGC amount. Well, if you don't take advantage of the amnesty, the penalty will automatically be set at a minimum of 100% and could then be up to 200%. But you're basically losing the ability for the Commissioner to remit that below 100%, which he can do in normal situations. Now, the amnesty is time limited, not only in terms of when you take advantage of the amnesty, but it also only applies to certain SGC quarters or SG quarters. Basically, it would cover the introduction of the SG provisions way back when, right up until the quarter starting 1 January 2018. For any quarters after that, the amnesty won't be relevant, and normal SGC provisions and penalty provisions will apply to that as well. So there is a potential opportunity for employers who may have got something wrong when it comes to SG in the past. We don't know whether this will pass or not, so we'll wait and see obviously how this progresses through Parliament. But if this does happen, there will be this window of opportunity for employers who may have outstanding SGC liabilities to really take advantage of this. And it's a win for employees as well, clearly, because anyone who's missed out on those super contributions hopefully will be kind of put back in the position they would have been had those contributions been made originally. So big news for the month. We'll wait and see how this develops, but certainly something to start thinking about already for clients where there may have been some issues when it comes to SG in the past.
Now, across to Garth for that new legislation that brings in LRBAs into the total superannuation balance. Across to you.
A bill passed through Parliament last week which covers 3 key issues, mainly carryover issues from the pre-election. The 3 areas this superannuation bill covers in regards to the new rules around super guarantee opt-out, the changes and updating to the non-arm's length income tax issues that affect self-managed funds, and the third issue is around how limited recourse borrowing arrangements can affect a client's total super balance. Now, each or all of these 3 changes could have wide application across your client base. Let's start with the super guarantee opt-out rules. Now, this essentially will apply where you have a client who has multiple employers. Each of those employers, in order to meet the super guarantee requirements, will need to make super guarantee payments for those eligible employees. If your client has more than one employer, each employer needs to meet their own requirement for that employee. Hence, this could create an excess concessional contribution for your clients unintentionally. Now, up until this bill passed through Parliament, there was no way your clients could essentially avoid that excess concessional contributions tax arising because the employer had to make the contributions. What this bill now allows is one of your clients or your affected clients to effectively opt out of super guarantee from one or more of those employers, so essentially removing the requirement for that employer to meet super guarantee obligations. However, one employer must still have an SG obligation. That is, you can't opt out completely. Your clients can only opt out where the multiple employer issue is relevant and it would take them above that $25,000 cap. Now, there is no actual requirement here for an employer to accept an employee's requests. There's a formal process the employees need to go through. They need to lodge an approved form with the ATO, which sets out from which employer they are opting out. But again, the employer doesn't need to abide by that. They can, in some cases, say, no, we'll continue to make those super guarantee payments. That could be relevant, for instance, where the employee and the employer don't come to an agreement as to how that remuneration would otherwise be paid. So if instead of being paid as SG, I want in my pocket, no, I don't agree, they could continue to pay as SG. They may also have other reasons such as software or payroll issues that wouldn't allow a individual or one employee to opt out of the system. So this opt-out ability is essentially a quarterly based opt-out. So your clients will need to apply to the ATO through an approved form which we downloaded from the ATO website. And our understanding at this stage is that it can be used per financial year. So you can apply to opt out essentially for the current and the next 3 or so quarters. So there could be a bit of admin which is going to be required around this opt-out issue. The second issue which was covered in the bill was around how the non-arm's length income rules apply to superannuation funds, but mainly self-managed funds. If you look at section 295.550 of the Tax Act, is actually quite deficient in its wording around how non-arm's length income of an SMSF could arise where an expense incurred by the fund was not incurred or paid at an arm's length rate. The wording of that section of the Tax Act is really more heavily worded towards income rather than the expense side. So Treasury, together with the ATO, identified this and have come up with some changes to how non-arm's length expenses incurred by an SMSF trustee can result in non-arm's length income applying to a SMSF. Keep in mind, non-arm's length income taxed at 45%, regardless of the fund being neither pension or accumulation phase. So 45% on the non-arm's length income. What we need to think about for our clients is what the expense actually relates to. So for instance, these changes don't necessarily apply to what I refer to as internal arrangements. So Garth, as trustee of my fund, I prepare the financial statements and tax returns for my fund. I'm doing that in my capacity as a trustee. It's an internal arrangement. Because there's only one party, me, the trustee, I don't have a non-arm's length income transaction because there's not two or multiple parties. The non-arm's length income rules apply where there are both parties, so more than one party. Internal arrangements, such as what I mentioned around the accounting expenses, wouldn't usually get caught here. However, let's just say instead of Garth being an accountant, Garth was a builder or Garth was a real estate manager and my fund owned real estate. And I provided services to my fund in that capacity as a professional property manager. And I don't charge my fund, or I charge my fund a reduced rate other than what I charge the general public. In those cases, it is not an internal arrangement, it's external. It's Garth acting in capacity as the manager of properties and the trustee. So in those cases, the income generated from the asset, the rental income, would be deemed to be non-arm's length income. So be careful with that one. That's probably one of the key areas where clients get caught in the provision of services to their SMSF. Just keep note of the restrictions that apply around trustee services, section 17A and B of the SIS Act. We won't go into that today. Just have a look at those rules when you can. The other areas that get caught under these gnarly provisions or changes are around capital transactions. So we're not just here talking about income the fund receives. Non-arm's length income issues can arise where the capital transaction is not conducted on arm's length terms. So for instance, I want to buy units in a related trust. If that transaction to acquire the units is not carried out at market value, then income and capital gains resulting from that investment would be caught under these non-arm's length income provisions. Again, this does have a fairly wide application to clients, those providing services to their fund, but also again, keep in mind the transactions. The other capital transaction that will often get caught is, for instance, where a fund acquires business real property from a related party. That can get caught if it's not done at market value, and as you can see, a significant difference in tax outcomes. What can often create this issue is, for instance, where the trustees are trying to add money or add value to their SMSF, in other words, by reducing their expenses. rather than making a contribution, or where they can't make a contribution, which would increase the value of the fund, the other occurs. We reduce the expenses. So this really is a way where the ATO can stop transactions occurring that would otherwise try and get around those contribution cap rules. The third issue covered in the bill which passed was around limited recourse borrowing arrangements inside a self-managed fund, and how these arrangements, these borrowing arrangements, can affect your client's total super balance. Really quickly, background, total super balance is all the money your clients have in super, in all funds, in pension and accumulation. So it's all their savings in super. It's relevant for a number of issues. It's relevant in determining non-concessional contribution caps, whether clients can actually have a cap, relevance for the bring forward rule around non-concessional contributions. It's relevant for tax and spouse offsets and co-contribution eligibility. So it is a wide application that is covered under the definition. What the bill has done has set in place that where a client has a SMSF with a limited recourse borrowing arrangement, and either that client is already able to access their super where they've met a nil condition of release. So that's age 65, or where they've retired, permanently incapacitated, or issues like that. So where the client has met a condition of release, a nil condition of release, and there's an LRBA within the fund, we need to add to their total super balance the proportionate amount of the outstanding loan. Two members in the fund, one, for instance, has retired with $1 million loan in the fund. If their balance were even, we need to add back essentially $500,000 to the member's total super balance. So what we're really using to calculate total super balance is the asset value of the funds, and we're not looking at the borrowings itself. The second way it gets caught, so this is the or, not the and, it's an or, is where there's a related party LRBA. So when the lender to the fund is a related party. Again, the same outcome, the proportionate balance of the outstanding loan is allocated to the members of the fund. So just keep in mind that the bill covers those two separately, where there's a related party LRBA or where the client has met a nil condition of release, not both. Either can trigger those outcomes. Keep in mind that when we're looking at a client's total super balance, it's usually determined for those eligibility issues I raised before as at 30 June of the financial year, the prior financial year. So when we're assessing total super balance for contribution caps, for co-contribution eligibility, remember it's 30 June of the prior financial year. So why has this essentially come up? What's the issue that's being addressed? If, for instance, I was approaching retirement and my total super balance was close or above 1.6 million, I could effectively withdraw my money, we're eligible from the fund, and then lend it back to the SMSF under a complying loan arrangement. That way, my balance is below the 1.6 million. So these changes essentially reduce the ability to get around the $1.6 million pension limits, but also the 1.6 million total super balance issues that we spoke about before. Now, all of these three changes have application from 1 July 2018, obviously once the bill does receive royal assent, which is almost a given that will occur. So with an application from 1 July 18, the one of those changes that is mostly affected by that backdating is probably the one about the SG opt-out, because there are some time frames around when you need to apply to opt out of that SG system. There's a 60-day period that says you have to apply 60 days prior to the commencement of that quarter to opt out of SG. Obviously, we can't apply now to opt out of SG for current quarters or the next quarter because the 60 days has passed. So we are expecting the ability for clients to be able to opt out now, where affected from SG, without having to wait for that 60-day application period. The 60-day, the 1 July 2018 application date. Now, when it comes to LRBAs and total super balance, just focus on your clients that may have entered into contracts or borrowing arrangements after 1 July 18. This change to LRBAs and total super balance only affects those arrangements entered into on or after 1 July 2018. So it won't affect any pre-arrangements or the refinancing of existing arrangements. When it comes to NALI, it's probably too late now anyway with the 1 July 18 start date. These transactions will essentially just get caught under the NALI rules.
Now across to Michael for that guidance on the tax treatment of distributions to foreign beneficiaries from Australian resident discretionary trusts.
The ATO has released some draft determinations which build on previous guidance that the ATO has given us dealing with situations where we have trusts and capital gains and non-resident beneficiaries. Now, this has been a bit of a problem area in practice in terms of a lack of really clear guidance, and it's a very technical area. Unfortunately, what the ATO's view as represented in these draft determinations means is that you may well have situations where clients have non-resident, foreign resident beneficiaries, and they are receiving capital gains through discretionary trusts, and they're going to end up paying tax on that in Australia, even though had they held those assets directly, they wouldn't have had to pay tax in Australia. And that's basically what this guidance is telling us. The reason for that is a little bit technical, but it comes back to the way that the CGT provisions interact with the trust rules and also the rules around non-residents as well. Basically what the ATO is saying is that even though there are some exemptions in the CGT rules for situations where a non-resident makes capital gains on non-taxable Australian property, so foreign assets, those rules are limited in their application. They can only apply when the gain is made directly by the non-resident or where the gain is made by a fixed trust that then distributes that gain to a non-resident. And the problem here is that in many cases we're dealing with discretionary trusts that are making capital gains on assets. Some of them might be taxable Australian properties, some of them might not be. Some of the gains might have a foreign source, some of them might not. But basically what the ATO is saying is if the gain is made by a discretionary trust, then the CGT exemptions that would generally be available to non-residents just can't apply. There's just, the rules just don't allow for that. So where a discretionary trust makes a capital gain, regardless of whether that is distributed to an Australian resident beneficiary or a non-resident beneficiary, then there is high likelihood of that being exposed to Australian tax. Now, the main exception to that is where the trust itself is a non-resident trust. And previous guidance given to us in this area basically says that where the trust is a foreign resident trust and makes a capital gain on a non-taxable Australian property asset, then that could potentially be distributed tax-free to a foreign resident beneficiary. This is a technical area. There's a lot to get your head around if you do have clients who have foreign resident beneficiaries, particularly where you're dealing with trusts that are not fixed trust. And it's pretty hard for a trust these days to be classified as a fixed trust. The other thing just to take note of is that this guidance potentially also impacts on situations where, for example, a discretionary trust, an Australian discretionary trust, holds units in, say, a managed fund. And where that managed fund is making capital gains on maybe foreign assets. Now, had a non-resident directly held the units in that managed fund, they could potentially receive their share of those gains on foreign assets without Australian tax. But if those distributions pass through an Australian discretionary trust first, it seems like that exemption basically is lost because it's passed through an Australian discretionary trust. So we need to be very careful about this. If we've got any clients with discretionary or other non-fixed trusts that have non-resident beneficiaries, need to very carefully consider what is happening with the capital gains made by those trusts. Consider the residency status of the trust. That seems to be pretty important. Where it's a non-resident, we then have to look at the nature of the assets and whether they fall within those categories of taxable Australian property or not. But if it's a resident trust, then basically what the ATO is saying is that those capital gains are going to be taxed regardless of who ends up receiving them. Now, the thing the ATO doesn't cover in these guidance or these documents is the possible application of double tax agreements. And that's a whole other story. Those, we're moving into, again, more complicated territory. So that is something that would need to be explored. It would depend obviously on the client's situation, but that is the missing element in this that would also need to be factored in to see what the final tax outcome could be.
And now Treasury's attempts to align those definitions of Uber-style ride-sharing services as a taxi for both GST and FBT.
Now, Treasury has released some draft legislation dealing with a few kind of amendments to the tax system. The one we're just going to pick up on for the moment is a proposed change to the way that the term taxi is defined for FBT purposes. Now, you might recall relatively recently the ATO had finalised its view on whether ride sourcing like Uber services are classified as a taxi for FBT purposes. And basically the ATO said that the way that taxi is defined in the FBT Act doesn't or isn't wide enough to capture things like Uber and other ride sourcing services. And the practical implication of that is that it means that where employees travel to and from work using ride sourcing services that are not kind of licensed taxis, the FBT exemption that can apply to taxi travel can't apply to that. Now, it doesn't necessarily mean that FBT applies. The minor benefits exemption would sometimes apply in these cases. But what the government's doing is basically fixing up the inconsistent definition of taxi that we have across a couple of different tax areas. Because the courts have said that for GST purposes, ride sourcing Uber services are taxis. So basically what the government is doing is trying to make those definitions consistent so that ride sourcing will be treated as a taxi for both GST, as it is currently, but also moving forward for FBT purposes as well. Which would mean that really from an FBT point of view, it should make no difference in terms of whether an employee uses a normal taxi or uses Uber or other ride sourcing services when travelling to and from work. The FBT exemption in future, if this passes, should apply in either case. So really just fixing up a bit of an odd inconsistency in the way that taxis are dealt with in the tax system. It's only draft legislation at the moment. Again, we'll wait and see how this progresses.
And that's the tax roundup for this month. If you're an accountant in public practice and you have not seen what Knowledge Shop has to offer, then give the team a call on 1800 800 232. We'd love to show you why thousands of accountants use our service every day. But until next month, we'll look forward to seeing you there.